And welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman. We speak about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. If you've not yet done so, please go ahead and subscribe to both the YouTube channel and to the podcast. And if you think somebody might find this of interest, why don't you go ahead and hit the share button and you can share it with them as well. So, one of the most common calls or emails that I'm getting from clients, from potential clients, is when do I predict that the AI bubble will burst? Okay, they think because I know. Okay, I got the secret sauce. Nobody else knows, but I know. So the question is, what do you do, right? How do you protect yourself from the potential AI bubble? Now, for those of us who've been in the business for a while and who are older than 40, let's say. I know I don't look much over 25, but I'm a few years over that. We remember the .com bubble and when that burst and how painful that was because it took, more than that led into like the lost decade where stock prices really didn't move very much. And high flying tech companies, tech stocks went to virtually nothing or went to nothing. How do you prevent that from happening again, or do you? Are you able to do so? Meg Bartlett over at Flow Financial Planning writes, bubbles are definitely a thing. When they burst, it's horrible. Although those of us old enough to have lived through the .com bust, especially if you worked in the tech industry at the time, it's all sorts of paper millionaires become paper un-millionaires overnight. If you could get out of the market right before the bubble burst, that'd be awesome. But you almost certainly can't. There are two problems with trying to get out of the market because you're afraid of a bubble. One, if you get out of the market too soon, you risk missing big gains. Number two, if you get out of the market at a good time, you risk missing big gains because you don't get back in a good time. Okay, I can tell you that. It is very, very difficult to time the market. I know people who actually have sold before market drops, large market drops, but they're still waiting on the sidelines, and we're talking about years, if not decades later. They were never able to pull the trigger again and get back in. So what good was it that they sold? They might have missed that 20% drop. In the meantime, the market's gone up 374%, and they're still holding out in money market because the market's going to drop and to go to zero. That's what their theory is. Okay. There's ample evidence, she says, that trying to time the market in any way puts you at a severe disadvantage in achieving long-term returns. Yes, the AI bubble might burst in 6 months, but also some of the best gains ever might occur in the next 5. Imagine getting out of the market earlier this year because of fears of Trump or tariffs or the AI bubble. Look at how the U.S. stock market has performed this year, which is really important, right? The market was up 16.5% this year, but remember back in April, the market dropped 20% in a matter of weeks. And people were panicked. And now people don't even remember. That's the upshot of all this. Okay. What are you supposed to do? So you can't time the market, she says. So what are you supposed to do? What makes for good investing, she asks. Well, there's boundless commentary on how to invest. I think most people will agree that there's a short, simple list for basics of good investing. Let's discuss some of those here. Number one, and I would call this, right, goals-based investing, right? What are your goals? What are your needs? So she says, know when you need your money. Do you want to buy a house or retire in 5 years, or is it in 20? You're going to invest your money differently depending on the answer. Why? Because if you invest in the stock market, your investments could lose half their value within a year and not recover the value by that 5-year deadline, and you would therefore be unable to meet your goal of home ownership or retirement. But if you have 20 years to wait before you need that money, you have more time to recover from stock market losses, including the AI bubble burst. Additionally, if you don't invest in the stock market for a goal of 20 years from now, your money will likely not grow enough to be able to buy or retire in 20 years. Be it too aggressive for a short time frame or too conservative for a long-term time frame, if you invest inappropriately for your time frame, you risk not having the money you need when you need it. Very, very important, something that we speak about here a lot. You really have to understand what are your goals and what are your needs. Once you're able to define those, how to invest the money almost just becomes like plug-in. Okay. People recently, I got a call, I think it was like 2 days ago. Somebody called me. They'd saved up a bunch of money in shekels here in Israel, and their goal is in 12 months to buy an apartment. Okay. They wanted to know if they should open an account with me and send the money to America to invest and then bring it back. And I said, whoa, no way, Jose. Just leave it in shekels, leave it here. You want to make a little money, stick it into an Israeli bank deposit. And that's it. Why? Because a year from now, first of all, it's not a long time. Okay. Market drops. There's a very good chance you're not going to be able to make back your money. And you need this money for your down payment. Additionally, there are costs involved with transferring money. So bad idea. I said, very, very bad idea. Why? Well, he said, well, the markets have, averaged over the last 3 years, 18% or whatever it is. I don't know what the number is, right? And I said, yeah, but that doesn't mean it's going to happen now. And what if the market drops 20% this year? Then what? You're not going to buy your apartment. And he was like, that's true. That's a good point. So, if you're investing for the next 12 months and it's all your money you've got and you have a really, really finite goal, then you have to be uber conservative, right? If you're investing for the next 40 years because you got your first job and you're in your mid 20s, you're right out of school and you got a job, you can be pretty aggressive. You can be smart, strategic, right? You don't have to put all your money in Bitcoin or who knows what, right? But you can get your money all linked or invested in the stock market. That's probably a pretty good idea. So that's important. Then she goes on, she says, know how flexible your goal is. Sure, it'd be cool to fly first class for that big trip around the world after the kids are old enough to appreciate it. But if we really have to fly coach or cut the trip short by a week, I'm okay with that. Or it'd be the bee's knees to retire in 5 years, but I also still quite like my job. So if I have to work another 10 instead, that'd be okay. If you can talk about your goals in this flexible sort of way, you're willing to adjust their price tag or their timing, you can be a little less strict in how you invest for them. If you have a lot of your wealth wrapped up in a company stock, this is very important. It can be very hard to know if you should sell any of it. Even if you know it's too risky to keep all the stock you have, the lack of logical strategy for selling it prevents you from doing anything. I disagree. Okay. I believe if you have company stock, you should set up a systematic sell program. Okay. Your whole life is tied up in that stock, right? If the company has problems, not only your options going to be worth nothing, your company stock going to be worth nothing, but you might be out of a job, right? So there's nothing wrong with, as your stock vests, sell it or, every quarter sell, whatever it is, set up something so you can take some money off the table and get it more diversified, right? Being a one-horse pony, and I don't care which horse that is, over time, in 99% of the cases, doesn't work out so well. Important, right? You would think, well, I've got shares in, I don't know, Microsoft or NVIDIA, they're never going to go down. Well, they did. They have. You don't know what's going to be in the future. I'm not saying that anything wrong with NVIDIA. I'm not saying there's going to be an AI bubble. I think AI is here, right? Here to stay. But that doesn't necessarily mean that the stock is going to keep rocketing forward forever. Chances are that's not going to happen. Okay? So she says, this is what she proposes. Identify the essential goals in your life, putting your kids through college, the kitchen remodel, down payment on the home, full financial independence at 55. Then tally up how much money you need to fund all those goals. 3, sell enough company stock to set aside for those goals after paying taxes. 4, if you have company stock left over after that, then you can be much more flexible at selling versus holding the stock. You don't need the money for anything essential, so you can afford to take more risk. I don't know. If you want to let some of the stock run so that you can become a multimillionaire, hopefully, if it hits, great. But otherwise, I would be selling systematically. I disagree with her approach. I do agree that on a more global, more macro level, and I say this all the time, right? You really have to define what are your goals and what are your needs. Okay? It's the ABCs of investing. If you don't know why you're investing, it's very, very difficult to invest and to try and just have as much money as humanly possible. I don't know. I've been in this business a long time. That generally doesn't suffice. It just doesn't. right? People who have it open-ended, even if you're young, like I said, and you're investing for retirement. So to make as much money as I can until I am 65 is a goal. Okay, but just to leave it open-ended, I don't know. I don't believe in that. I don't think that's I don't think that's a great approach. Okay. She goes on and on, but I'm gonna stop here. So, how do you protect yourself from the bubble if there is a bubble? I would say first and foremost, know why you're investing. What are your goals? What are your needs? Then you create a portfolio which will enable you to achieve those things. Okay, you don't, first of all, don't put all of your money in AI. Number one, you want to diversify. Those of you who are still listening and got the little rhyme, congratulations. Diversify, right? It's so funny. Everybody said the S&P 500, S&P 500, and then you look and go, wait a second. Hey, for the first time in a long time, global markets outperformed the U.S. Huh. Maybe I should have some exposure to global markets. Now, what you should not do is start trying to follow last year's best performers. That's a bad idea. Okay. What you should do is just use an elementary asset allocation: large U.S. stocks, mid-size, small, international, emerging markets, if you want. That's how you sort of, in a nutshell, you create a portfolio. Obviously, speak to your advisor. It's more complicated than that, but don't just chase after what was hot last year. That's probably not a great strategy. Okay. So know what your goals and needs are. Then get the money invested, diversify. It's so important. Again, everybody thought S&P 500, man, that's the boom. Everything's going to keep just winning out. And last year had a nice year, but there were markets that did significantly better. Okay, that's why you want to diversify. And on the downside, it's also a way for you to potentially not lose as much money. Okay, so those are a couple of tips on how to prevent, if there's an AI bubble, getting smoked. if it explodes. Okay. You've been tuning into the Aaron Katzman Show. We speak to life and money and your investments. If you like this content, why don't you hit the like button below and like it? Why don't you also subscribe to both the YouTube channel and to the podcast? And if you think somebody might find this of interest, why don't you go ahead and hit the share button and share it with them as well? Thanks so much for tuning in, and we'll speak to you soon.